Hey everybody! Today we're going to give you a sample of a free course we have available on our Payments Professor website. It's a free course that covers the different payment channels available in the United States. It's designed to educate everyone on what payment channels are and how they work. This particular episode is going to focus on checks. Enjoy! Hey everybody, and welcome to the check section of the Introduction to Payment Channels. Let's think about what a check really is. It's a piece of paper that represents some value. That value that is being that you can exchange that piece of paper for the amount of money the check has been made for. How about a quick history lesson on checks though? See, the earliest usage of checks may have originated with ancient Romans, as they had something called the prescriptiones. Okay, I know I butchered that like I butcher a lot of things. But checks resembling what we have today are more definitively traced to 9th century Muslim traders. Think about it. As international commerce grew and required merchants to travel in person over multiple weeks, even months, merchants were often burdened with big bags of coins they needed to carry with them. Wouldn't you like to have that problem, having to carry around a lot of money? Actually, I would. Okay, let's keep going though. That led traders to invent what they called the sack. I may got that wrong too, S-A-K-K, which was a piece of paper with instructions to the merchant's bank to make a payment from that person's account. A sack could be cashed in another city or country, making travel easier and safer from theft. But it wasn't until the 15th century that checks began to be used in Europe. They became especially popular in Amsterdam, a major trading hub. Because checks were written by hand, however, fraud, it was extremely high. Truth is, whenever there is money involved, there tends to be some type and level of fraud that is associated with it. Remember, even when we talked about cash, there was a lot of counterfeiting that took place, especially in the early days, and still does. And it's not just with checks that we see this, we see it with a lot of things. The first checks started cropping up in the United States toward the end of the 17th century, and the first printed versions were introduced in 1762 by British banker Lawrence Childs. Before that, checks were simply written out by hand, sort of like IOUs. But Childs printed checks included serial numbers on them, and that was for record-keeping purposes, which granted bankers the ability to check them against a ledger of what had already been written. Apparently, checking them and the term check stuck. Checks are still a very popular way of making payments in the US today. The process of exchanging value through checks is generally called check clearing. The entity, the business or person making the payment, the payer, don't you like when we use the same terms in this one? We do. Is referred to as the maker of the item. Oh wait, I just threw you a curveball, there's another term for it. Well, because think about it. They are making the item or the check that they write. They then drop it in the mail, or they could just hand the check over to the person, which could also be called a draft to the payee. That's another way it could be done. And as we said in the introduction video, again, we have multiple terms for what we use, multiple terms that are used in different payment channels. And sometimes, like now, there are multiple terms used for the same thing with the same payment channel. The payee, though, they deposit the item in its financial institution, and it is then up to the financial institution to determine how it will receive value from the maker's bank. This is where we see the two banks, the payer and the payee's financial institutions, doing what we call exchange. They exchange the items. They exchange them for value, the checks for the value with each other. They exchange the items for value with each other. We know this as the settlement process. The maker's bank, having been debited for the value of the item, then charges the maker's account for the value of the check. They take the money out of the account from which the check was written. Pretty simple, right? It pretty much is. Now, what are you going to find on a check? If you look, a check contains the names of the payer and the payee, the payer's account number, the amount of the check, the date the check was issued, and the name and routing number of the maker's bank. Now, you may see additional information, but the name of the payer, the signature, the amount, and the account number, plus of course the routing number, because we need to know where it's going to go, those are almost always there. They're usually there, let's say. The account number and the routing number, they can be found at the bottom of the check. There's generally a coding strip at the bottom of the check that enables high-speed processing and readers and sorters, the equipment to be able to quickly process and read them. In the US and Canada, the coding strip we use is called magnetic ink character recognition, or MICR. Now, you can say MICR or you can say MICR. It's really a long-standing debate as to which one it should be, but both are accepted. This high-speed reading capability helps us achieve what we call STP, or straight-through processing. Used to be checks were physically exchanged, and it could even take days for checks to clear because a check had to travel back and forth between financial institutions. So a check written from a bank in, say, California, but cashed at a bank in Florida, well, it had to make that trip back and forth. Now, they still do make that trip back and forth, but the Check Clearing Act of the 21st century, it made it easier. Because of that, we have the ability to electronically exchange images and send them much like we do an email with a file attached. But of course, these image files, or we call them ICLs, image cache letters, are sent across secure channels. The check payment channel, to be more precise. Checks can still be processed though in many ways. They can be exchanged directly between the financial institutions that they go through. They can be exchanged through the Federal Reserve Network, the Federal Reserve offering some check clearing systems. They can also be exchanged through check clearing houses. There are many ways that a check can be processed and exchanged. That wraps up the basics on the check payment channel, for it is its own payment channel. And it has its own way of being processed. And it is, again, one of the most popular. Well, it is a very popular method for businesses to still process items. Well, why businesses? Because a check gives us remittance information. Remember, you can write information on there. You can send a check with a what we call remittance statement, or it could be, say, with a bill. You get your electric bill in the mail. You get that little statement that you mail in with the check. Having those two pieces of information makes it easier for a business to know whose account they need to be crediting for the check that they've received. I hope you enjoyed that. If you would like to see the full series, well, it's free. It's free on our website. Just go to paymentsprofessor.com and sign up for the free course. We also have additional courses available, and more are coming and in production at the moment. And we have information that's there, and it's available to be able to aid you, the payments professional, in learning everything you need to know to advance your career, get that raise, maybe even that promotion, and to do so while protecting your financial institution, your fintech, your business, and your customers. If you have questions, you got comments, as always, please feel free to email me, Kevin@paymentsprofessor.com.